Your cap table is the one document that's supposed to show you exactly how much of your company you actually own. But the way a lot of founders build it, it never really gives them that number, and they only find out when they're raising money or trying to sell. As a 2x founder myself who now runs a law firm specifically for startups, I've reviewed hundreds of cap tables, and the ones that didn't add up almost always made the same mistakes early on. So in this video, I'm going to show you the 4-step process you can follow to build your cap table the right way, so you always know exactly what you own and your cap table never gets in the way when it's time to raise money or sell your company. So let's dive in. Step 1, start with shares. The first thing to understand is that your cap table runs on shares, and the percentage everyone talks about comes straight from those shares. A lot of founders open a spreadsheet, write down that they own 60% and their co-founder owns 40%, and they think that that's their cap table. But a cap table is a list of every person who owns part of your company and the exact number of shares that they hold. And your percentage is just your shares divided by the total shares that the company has given out. So the moment you bring anyone else on, the total number of shares goes up and everyone's percentage changes on its own. So if a percentage was the only thing you wrote down, you no longer have a clear idea of what you own. With that being said, the right way to start is with a fixed number of shares you control from day one. When you first set your company up, which is called incorporating, the standard is to create 10 million shares, and the founders usually take or split around 4 million to 9 million of those shares split between them. So if it's you and one co-founder splitting that evenly, you each hold 4.5 million shares, and everything you give out after that comes from the shares that you have left. The most common mistake I see here at this stage is a founder who creates 10 million shares and gives all 10 million to themselves, or maybe they don't create enough shares. In their head, they're locking in 100% ownership, which feels like the right play. But now there are no shares left to bring on a co-founder, give to early hires, hand to an advisor, or to create a stock option pool because the company has nothing left to offer anyone. This is because fixing it means going back and increasing the number of shares the company is allowed to create, which is more paperwork, more legal fees, and a headache for no reason. Now, real quick, if you'd rather not risk getting any of this wrong and just want your cap table and legal setup built correctly from the start, or maybe you're raising and you've heard that keeping your cap table clean is one of the biggest sticking points of a fundraise, click the first link in the description and book a free consultation with me, and I'll help you get everything sorted. Now, let's keep going. Step 2, count the shares you haven't given out yet. So once you're thinking in shares, the next thing to get right is counting the shares you haven't even given out yet. What you really own includes a lot more than the shares that are in people's names today, and that full number is called your fully diluted ownership. Fully diluted just means counting every share that could exist someday, including the equity you've already promised people but haven't formally handed over. That's because a big part of your shares are usually spoken for long before they ever show up in anyone's name, and they all come out of your ownership. So the first thing that lowers how much you own is the equity you set aside for your team. It's standard to reserve a portion of your shares for future employees, usually around 10 to 15% of the company. Those shares aren't in anyone's name yet, but you've already promised them away, so your honest ownership number has to count them. The next thing that lowers it is money investors have put in through a SAFE or a convertible note. A SAFE, which stands for Simple Agreement for Future Equity, is basically a promise that turns the investor's money into shares later, once a bigger investor comes in and sets a price or a valuation on your company. A convertible note does the same thing, except it's technically a loan that turns into shares down the road. So even though nobody's holding those shares yet, they're coming either way and they count against how much you own, just like everything else. So when you add all that up, what you own is usually a lot lower than the number in your head. That fully diluted number is the one that investors, acquirers, and any good lawyer is going to care about, so it needs to be the one that you care about too. Founders are often surprised and taken aback, especially when calculating safe math with multiple different valuation caps and find out that they own less than they expected because they didn't model their ownership throughout their processes. Step 3. Back every share with paperwork. Now, even when the numbers look right, a cap table can still cause you problems, and the issue is that the shares on it were never backed up with signed paperwork. Every share on your cap table needs to match a signed document, the same way every number in your books has to match a receipt. This is because every share is a legal claim on part of your company, and if there's nothing signed behind it, that claim becomes a problem the moment you try to raise capital or sell. And those signed documents are one of the most common things founders skip. Every founder's shares should have a signed stock purchase agreement, every share you give your team should have signed paperwork behind it, and every investor's safe or note should be signed and saved somewhere safe, like your data room or a Google Drive. A lot of founders promise equity in a quick conversation or an email or a back of a napkin and never put it in a signed agreement, so they end up with people who believe they own part of the company and nothing official that says how much or with what terms. That's a problem. This also includes shares that should be repurchased. There needs to be agreements to repurchase the shares of people who have left your company, and it catches up with you the moment a serious investor or buyer starts reviewing your company. This part is called due diligence, where they go through every share and every promise and check it against the signed paperwork to make sure that you own what you say you own. If someone shows up claiming they were promised shares that were never written down or the numbers just don't add up, the deal can stall for weeks, or the buyer or investor can just walk away. One of the biggest problems that founders don't recognize is that when a co-founder or an employee leaves, the company needs to properly exercise their right to repurchase unvested shares, which is usually via a stock powers and assignment. They need to repay the person leaving the fair market value that that person paid to initially purchase their shares. You can also make an offer to repurchase vested shares as well, and you want to make sure to obtain a settlement and release agreement from people who leave your company, which goes alongside the agreement to repurchase the vested shares. Step 4. Update it before every raise. Something I want to mention is that even a clean cap table only does its job if you keep it up to date and use it to look ahead. A lot of founders treat it like a file they fill in once and forget about, then panic when it's time to raise and realize it's months out of date. But the right way is to update it every time anything changes and to know exactly what you'll own before you agree to a new round. Keeping it updated is also what lets you see your dilution. And dilution just means your part of the company gets smaller as new shares get created for investors, employees, so on and so forth. And it happens at every round and various stages, whether you plan for it or not. And it's not a bad thing because it usually means that your company is increasing in value. One of my favorite phrases is that it's better to own 1% of a watermelon than 100% of a grape. Said another way, it's better to own 1% of a company worth $1 billion than 100% of a company worth $1 million. So before you sign anything, you run your numbers, see what your cap table is going to look like 2 or 3 rounds from now, and that way you can plan for it instead of just reacting to it. Because the founder who knows their dilution going in can plan and negotiate, while the one who's guessing and isn't intentional in planning has it come back to bite them later, usually at exit when it's too late, and this is how founders end up with nothing. Now, the last thing is getting your cap table off of a basic spreadsheet and onto a dedicated cap table software. A spreadsheet is fine when it's just you and your co-founder, but as you add people and raise investment rounds, it gets hard to keep straight, and one wrong formula can throw off everyone's ownership. This is why tools like Carta, Pulley, or Fidelity Private Shares exist, which are softwares built specifically for keeping your cap table accurate. They track every share, everything you've promised your team, and every safe in one place, so the math stays correct as things change. Around 90% of the founders I work with are already on a dedicated cap table platform, so it's pretty much the standard at this point. Now, if you're just getting ready to raise or you want clarity on how much of your company you actually own, this is what I help founders with every day. Sure, you can do all this yourself, but once safes, new hires, and a few rounds come into play, it's easy to lose track of what you have. So if you'd rather get it right the first time, click the first link in the description and book a free consultation call with me. On that call, we'll go through your cap table together, figure out what you own once everything's counted, and map out what to fix before you ever put it in front of an investor or a buyer. So again, you can book your free consultation call by clicking the first link in the description. And if you want to understand how to answer the 12 most common investor questions, then check out this video next.